right, welcome everybody. Thanks for joining us. Can you believe this production? Unreal how big it is this year. So thanks for everybody for coming. So I'm Noah Buxton. I'm a partner and I lead the digital assets practice at Ametrano. We're a large public accounting firm. We've been servicing the needs of the crypto and digital asset space since 2014. Got some great guests with me today. I'll give them a second, but first I just want to say that the purpose of this panel is to dig into institutional custody and some of the challenges from multiple viewpoints. And we've heard a lot about institutional custody or institutions entering the space, right? Even in the previous panels. So let's go a little bit deeper. One of the key layers underlying this institutional market activity is custodianship, or the safekeeping of crypto assets, Bitcoin assets. So let's get into it. I'll give each of you a few words to introduce yourself to the audience. So let's start down at the end. Ferdinando, if you would.
Thank you, Noah. Well, I discovered Bitcoin in 2014, and I was 20 years into my professional finance career, investment banking, asset management, but I got hooked, and Bitcoin has since then become my major professional and personal interest. I do teach Bitcoin and blockchain technology at various Italian and European universities. I started Digital Gold Institute in 2018 as a consulting firm, and from that consulting firm, I do run CheckSig, which is a custody and Bitcoin solutions for private investors and institutional investors.
Thanks, Ferdinando. Michael.
So my name is Michael Shaulov. I'm the CEO and co-founder of Fireblocks. We started Fireblocks about 4 years ago, and what we build is basically custody technology service that powers right now over 1,000 institutions. So basically it's the entire backend that allows them to securely store digital assets, including Bitcoin, and settle them across the Fireblocks network, so basically transfer them securely, and also provide a lot of the new and advanced services like basically access to DeFi and other exciting applications like staking and so on. My background is actually in cybersecurity, so the first 2 decades of my career I spent in the cybersecurity space before starting Fireblocks.
Thank you. I'm Henson Orser. I'm president and acting CEO of Komainu, an institutional-grade custodian for digital assets. We announced Komainu back in 2018 as a collaboration with Nomura, CoinShares, and Ledger. And we saw the writing on the wall that for when financial institutions got into the digital asset space, which was really a question of when, not if, that they would need a foundational layer of regulated custody to store those digital assets securely for them. So fast forward to 2020, we launched and are growing our operations globally with just announcing this morning that we've opened an OpCo in Singapore to be our home base for APAC.
Thank you all. So Henson, I'll keep it with you for now. What really determines the difference between institutional and other, or institutional and retail? Let's start at the highest level when it comes to custody. What really makes institutional custody different from other sorts of custody solutions that individuals might use in the marketplace?
So the way I think about it, and I know the narrative of individuals and retail and the sovereign self, et cetera, when I think about institutional investment managers, they're managing other people's money. And a foundational layer of that is that when they express an investment thesis, that when they claim that they've invested in assets on behalf of their clients, they know those assets are being stored securely, they can audit and see them there. And most importantly, if it's a successful investment thesis, when they go to redeem the assets, that they're actually there where they can return the performance to their own clients.
Michael, this one to you. So what do you think is the biggest driver or demand driver for institutional custody solutions today? Where are you seeing it in your business?
I would say that we are seeing it across the board, right? Started somewhere at the beginning of the pandemic, right? When we started to see more and more institutions coming in, and I think that initially a lot of the reasons that probably still relevant today, right, is the fear from inflation. I think that really over the last month and a half with everything that's going on in the world, like every instability is actually sort of increases the appetite to re-platform or to utilize digital assets and specifically Bitcoin. In terms of the institutions that we are seeing coming in, it's actually a mix, right? I would say that you're actually seeing a lot of the traditional asset managers, a lot of the traditional hedge funds coming in, and they basically want to understand and utilize it. You see some of the traditional banks, trying to figure it out and implement different levels of solutions to participate in this market because they're afraid of being disintermediated or become irrelevant because of the great stuff that the folks here on my left and my right are doing. And then we actually seeing, I think, and this is probably the most exciting category for us from what we call institutions, is actually the fintechs, right? So you basically see the entire innovation layer that been active, for being innovative in finance for the last 2 decades, jumping into this new world and really taking very innovative approaches. It's probably most of you guys familiar. I think PayPal was one of the first big names. Actually, Square was clearly done it before them. But I think right now, any fintech app, any fintech offering that we're seeing out there is really figuring out how they're going to also service crypto, whether it's buy, sell, hold, or actually more innovative use case like the payment use case that was discussed here before us.
What do you say to that, Fernando? And maybe talk about the change that you've seen in demand.
The change, sorry?
Yeah, the change over time, over recent.
Well, I mean, definitely Bitcoin and the crypto space is not the Wild West it used to be, but there's still a lot of uncertainty and confusion. As an example, when people have to figure out the difference between custody solutions, oftentimes the professionals that try to do that are not well equipped. And they come from the traditional financial world where the system of depository bank and custody is, test battle by 20, 40, 70 years. And so there is still a discovering process that we'll have to deploy in the coming years in order to allow people to make the right choices. Just commenting like what institutional custody should be, like SOC attestation, insurance coverage. There is a lot that could be added that is taken for granted in traditional financial world, cannot be taken for granted in Bitcoin, and probably should be managed in some way.
And I would add to that, I think 2020, 21, from my perspective, was one, Bitcoin became acceptable as a financial asset. It worked on the debasement of global currencies, and it went up in price when central banks printed a lot of money. And some institutions were able to make that expression, be that insurance companies, corporate treasuries, or even crypto-native asset managers. So many regulated institutions and investment managers now want to be able to make that expression, but they have to do it in a compliant manner. And then similarly, on the perfection of the technologies, whether it's some of the work Michael has been doing, or some of these incredible protocols like a Aave or a Compound or a Uniswap, there's incredible efficiencies around that on payments, settlements, liquidities, and regulated institutions want to benefit from those perfected technologies, but they need to do it in a compliant, regulated manner.
So there are a wide array of what we might call institutions, all the way from relatively small individual funds, LP type structures, all the way through large investment banks. Is it absolutely necessary to have institutional custody for some of these players? You mentioned regulated players. I would think the answer is yes. What about down from that? Thinking about investment funds, do they necessarily have to have a custodian, or is this a question of build it ourselves, be comfortable with it ourselves, secure it ourselves, versus being able to confidently outsource that custody responsibility? What do you think?
Maybe I'll take that. So I think that clearly as you basically go into the more active managers, right? Which is, by the way, a lot of what we do and where I think our strengths as Fireblocks. Definitely some of the approaches that you see over there is that they prefer direct custody, but it's still institutional grade, right? The main difference between using like self-custody like MetaMask or your favorite app to using Fireblocks or to using offerings like Komaino or other offerings, right, is the institutional or basically like the complex tool set that you have to maintain the security, maintain the governance over the funds, right? You need different set of policies, you need different level of controls, you need integrated AML, you need all those things regardless if, regardless, I guess, like, what's your strategy. In the second that you basically, more than one person, in the second that you're managing millions of dollars of others people or even like your own funds, you need those controls because basically the impact of, whether it's like a cyber attack or actually something that we see quite often, an insider threat or a fraud, is so substantial that you have to protect that. Otherwise, you basically have fiduciary duties, right, to whether you're investors or anyone else. And therefore, you just cannot use retail tools to achieve that. And every time that we've seen someone using retail tools, that's usually, leads to some disastrous results.
Yep.
At the same time, you cannot invent your own crypto each and every time because otherwise that will be risky on a different level. So I think that the industry has still to grow up and mature in terms of public auditing and open source solution and even the transparency on the insurance guarantee, what they are covering, what they are not. Otherwise, this still feel like an attempt of providing services, which can be brilliant and for a very fast evolving ecosystem, and you will need to evolve fast. But at the same time, security and custody, they require time, they require well-assessed processes, independent audit, and so on and so forth.
Fantastic. So what I heard you say is if I need you to hold my beer at the bar, you guys are the perfect people to do it. You're going to think about all the boxes you need to put around my beer, right? What are the sort of, if someone can explain in a simple sense, and then we'll go a little bit deeper, what are the custody models? Like what are the actual technical tools that institutional custodians use to secure Bitcoin assets for customers? And, are those easily explained? Is it a wide array of tools? Is it, one or two things, and essentially it's really about the people and the process that you put around the technology or the actual wallet solution? Maybe Michael first, and then.
Okay. Well, at CheckSig, we try to have 3 pillars. 2 of them already kind of talk about, which are SOC attestation, that is the independent audit of an external third party, and insurance coverage. This is just from the traditional point of view. Then we adopt a transparent custody protocol, which is open on our website, can be verified by anyone with technical experience based on multi-sig, on of course 2 cold levels with different multi-signatures being involved of different actors and different partners, and we provide proof of reserve. I think this is another key point that industry will, or should even, adopt more and more. That is providing a public proof that the funds that you have been entrusted with have not been lost. Otherwise, the chances might be that 5 years down the road, some vault will be open and will be found half empty or almost empty. And I think that the technology is there, especially for Bitcoin, which is a very mature technological environment, less so for alternative coins, but we should strive toward the most and the best transparency possible.
Yeah.
Okay, so multi-sig for Bitcoin, and Michael, your solution is very different, right? MPC or multi-party?
Yeah, slightly different, right? So we use MPC, so maybe just to explain the slight difference over there, right? The idea behind the theoretical ideas behind multisig and MPC are actually very similar, right? It's basically to remove a single point of failure by requiring multiple parties to sign a transaction. The first attempt, which is definitely been proven to be very solid attempt through the history of, is multisig, which was invented for Bitcoin. The main challenge with multisig is actually, as Fernando mentioned, is actually when you start to traverse across all the other blockchains. Because, for example, on Ethereum, you don't have really multisig in the same form that you have for Bitcoin, and you would need to implement through smart contract, which traditionally created the parity hack. And as you start to go through Solana and all those other chains, you don't have exactly the same construct. MPC is basically a very similar solution, which requires multiple parties to sign over a transaction. But the uniqueness of that technology is that it's actually operating on the encryption level, and therefore it is transferable across all the different blockchains, right? So for us, we use MPC as the underlying key management distribution. And the benefit of that is that we support right now over, I'm not sure exactly how many, but over 30 different blockchains with a single algorithm that works exactly the same way. Again, the auditability, the third-party audit is critical. I mean, clearly, if you have one algorithm, it makes it slightly easier because you can, if you dedicate $500,000 to do third-party audits, you can use now 5 different firms and do it on one single code rather than basically use it on like one firm that will audit 5 different code bases. So there is an advantage of using MPC. Another thing that we actually strongly believe in is basically in this approach of multi-layer defense, right? So with our MPC, we are one of the only players, I think, that are actually implementing MPC in hardware, right? So basically, it's like a combination of HSMs and MPC, and that makes it very powerful because not only that you are protecting against like an attack where there is no single point of failure, but even if the entire construct is compromised, you still have the second layer of defense around the hardware that makes it much more difficult for the attacker. Now, with regards to the important point around proof of reserve, I think that there are actually like a couple of different approaches. One of the approaches that are being taken with both multisig and MPC is the fact that when you enter into a structure over the wallet where the client has one of the key shares, right? Then effectively every client or every wallet, the funds are fully segregated and they are basically visible on chain. So the client can actually, every second, they can basically prove themselves that there is a proof of reserve, right? Because they can, execute those transactions by themselves. But I do agree that it's a critical component. I think that the running hack from last week was, I think a good example of the fact that it actually took people 5 or 6 days until they figure out that the funds are not there. And that's a very problematic situation.
Michael, I hope I'm not too provocative, but would you agree that MPC is subpar, at least when it comes to Bitcoin?
No.
It's definitely required for alternative coin, but why to use it for Bitcoins?
There are a couple of advantages. The first one is actually fees. And the second thing is that, with multisig, what we've seen is that at the end of the day, you are relying on the implementation on the node level, right, to validate that logic. And for example, with some node implementations, without going into too much details, when we started the company, we actually discovered that one of the node implementations, which was the second most popular, they didn't properly validate the multisig signature. So you actually would do, if you had like 2 out of 3, you could actually put 2 signatures from the same one, and they would still basically execute the transaction. So I'm not saying that multisig is not a good approach. It's a good approach, and it was proven to be a very powerful approach for the duration of the life cycle of Bitcoin. We started actually when we started the company, we actually implemented our Bitcoin wallet on multisig and Ethereum on MPC. And very quickly, we basically moved to use MPC across the board because of the operational complexities that also being represented with multisig. But it's like, really depends how you would use multisig without getting into, I guess, too much details and exhausting all the time here.
I would elaborate just a quick sec on your question, which is there's the cybersecurity and things that keep us awake at night, of course, are the risk of getting hacked or having an incident. And we work with best-in-class technology partners on that, and we make sure that if the system goes down, we can recreate or recover our clients' assets. But as Michael said earlier, then there's also operational risk, and whether that's employee collusion or fat finger risk. We also have very strict controls and policies and procedures for when you're moving around large amounts of money on behalf of institutions, that you have the right span of control on that so that you don't have operational risk error. And then, of course, finally, who we allow in under the tent with proper KYC, AML, knowing our clients, their source of funds, and making sure that we're not facilitating anything illicit is sort of the third component that is best operating model for custody.
I'm hearing that if you want to secure Bitcoin assets in a wallet, you've got single sig, multi-sig, and you've got potentially an MPC or sharding solution to that. I think that's the universe, essentially, but Michael's telling me there's also MPC with hardware, which I need to learn more about. Do we have, I think that Henson has just addressed the fact that that's the technological layer at the core, but ultimately you have to invite people into the process, humans into the process, and you have to invite other technology and surrounding integrations into your custody solution in order to make it work for clients. Do you think that we have enough standardization in those other layers of the onion? You know, some of the things that you were just alluding to, Henson, like, you know, controls around segregation of duties, around entry of data, things like that. Do we have enough standardization? Is that clear to custodians in the marketplace what they should be doing, or is it just a universe of best practices that they're doing the best to choose from?
So I don't think we have enough standardization, and what I just described on being a proper safekeeper or custodian, we could be a self-regulated organization because that's what keeps us up at night, and that's what we're very disciplined about. But for the regulators to understand that, there needs obviously to be some sort of synchronization around that. But the standardization, no, I don't think it's there at all, and we spend a lot of time thinking about the technology layer, the middle layer architecture that integrates all of that into a unified framework.
Yeah, I would add that it's basically, right now there is no standardization, it's best practices, and I think it's more than best practice. I think right now this is like the unique IP of companies like Komainu and others, right, that they put a lot of thought and analysis into how to create those best practices. I think that unfortunately, most of the regulators, in terms of where they at, they're somewhat behind getting to the point where they will actually create a standardization around it.
At CheckSig, as a challenger, because of course our company is much smaller than yours, and we really believe in standardization. That's why our custody protocol is open, and I know that this is a very technical audience, so anybody who wants to spend some time peer reviewing our protocol or providing feedback to the custody protocol and the proof of reserve, which, by the way, even if we have some aspect of it patented, we have our patents in the COPA, Crypto Open Patent Alliance, so any of our ideas can be used by anyone. We really think that standardization, and that is open standards, should be the way forward. I feel personally very uncomfortable about security by obscurity. You know, I trust you, I trust Henson, I trust your companies, but I would love to see more, you know, about the internal process being documented and being verifiable by anyone. That's what we aim for at CheckSig.
Go ahead.
I'm just going to say one other thing. There are some regulatory frameworks that are being developed in sort of pro-crypto, pro-digital asset jurisdictions. So you can think about the work Singapore is doing. You can think about the work that they've done in Switzerland. Dubai has made some announcements just recently, as well as the UK yesterday, about trying to create a regulatory framework with the top 25 to 30 players that is best in class and FATF compliant and actually fungible and passportable to any jurisdiction globally. That's the intent. And if you compare that to some of the more legacy tier one regulatory environments like the United States, for example, they have so many different regulators and sort of power brokers involved that it's hard for them to synchronize or even take a blank slate or a whiteboard and try and think about how they would construct it from the bottoms up if they had a zero base to start with.
You were right on the same thought track that I had about that regulatory framework. No, that's great. I think even then, I wonder if there's enough for customers in the space to properly assess solution to solution. What is the right custody solution from the customer or the asset manager perspective? I know you all now. I know that you guys have great solutions in the marketplace, but how does the customer, I feel like that's one of the big challenges in institutional custody, is assessing, solution to solution. How do we compare them as apples to apples, let's say? Are you guys seeing that as a challenge? Do you find that there's...
I mean that's for sure a challenge, right? And I think that a lot of the people that are currently entering the market, right, they trying to basically analyze or understand the market in the eyes of someone who is used to the old system. Clearly, the properties here are so different, as we discussed. The considerations here are so, like, the things that are required from us are very different than what is required from a traditional custody bank, right? This is much more of a, advanced technology, advanced processes, cybersecurity play, rather than, I think, a lot of the things that are required from the traditional players. Now, I think where people are hitting, or where the challenge is that they don't always understand what are the implications of their use case, right? Because I think that choosing the proper solution is really understand what is your use case, what are you required to do, right? There is clearly a big difference between I want to buy Bitcoin because I think it's going to appreciate over the next 5 years, and I can put it in a very secure, safe, environment. I can pay a lot of money for insuring it. To I'm going to run an arbitrage strategy between multiple exchanges. I need to move the money 50 times per day. It's not sitting in a single wallet. And those use cases, right? I need to stake them. I need to do other things. Those use cases, they really sort of determine which providers you can work with, which providers will be the optimal for you, which providers can give you, I guess, the best return of investment. And I think this is, a lot of where we see the gaps.
On custody selection, there, of course, you have to have secure, compliant, and transparent as a foundational building block. Then we like to think, and Michael and I have discussed this, from that regulated foundation, how do we help traditional financial players get the benefits of decentralized finance? So how do we use that as a gateway for on-ramp, off-ramp, and then integrating with the digital asset metaverse? We can do secure custody, but then it's how do we figure out how to help people get extra yield from their assets that are in custody? We announced Komainu Yield with staking as the first feature. And then how do we figure out how to help people benefit from the network of payments and settlements and integrations to all things DeFi? And it's an interesting challenge because that has to be done in a secure transaction model as well. But we have some initiatives underway that custody is the first stepping stone to all the added services that can go on top of that.
It's kind of an enabler for modern or advanced financial services. We serve high net worth individuals and financial institutions. And in those cases, I'm all familiar with not your keys, not your coin, but for financial institutions, they cannot do self-custody by regulatory reason. And there are high net worth individuals which are not comfortable with the technical risk and the physical risk also associated with self-custody. And for them, there is a world of new services which are starting out. There is days where I see my company as a provider of technological solution to institutional player or institutional investors. There are other days where I feel like we are more like a private bank for high net worth individuals. We are taking care also of their tax issues and digital estate planning. So there is a lot of needs and requirements which are not really satisfied for the time being.
The fact that Bitcoin is a bearer asset, right? The fact that, it's really in its core character different than other financial assets that we're used to dealing with at the market, that are prevalent in the marketplace. I guess what I'm saying is holding securities as a ledger entry, if you're a broker or a custodian, holding them as a database entry is really fundamentally different than holding private keys on behalf of a customer. How do you all see that difference in responsibility? Is it a different responsibility? What are the implications of the fact that Bitcoin is a bearer asset? Does that change much as a custodian for you? Maybe Henson, you first.
Well, I mean, being a custodian of Bitcoin, we have responsibility around private keys and disaster recovery, and we feel pretty confident on our technology. The more cocktail conversation around Bitcoin as a bearer asset and the implications of that. I mean, let's not forget that people who have hacked large amounts of Bitcoin, they still have the issue of on-ramp and off-ramp. It's sort of like stealing the Mona Lisa, right? Like, what are you going to do with it? And although they tried to obfuscate getting value out of their hacked Bitcoins, like many of them have gotten busted because it's a public ledger for everybody to see.
Okay.
I love your question because in a way, I mean, Bitcoin is digital as Apple stocks or US treasuries. But nobody can steal 2% of Apple or 3% of the US treasuries because they are not bearer assets. At the same time, if you think about Bitcoin as a digital gold, again, if you want to steal gold from Fort Knox, you have quite a few logistic problems to solve. With Bitcoin, you don't have that. That's at the core of the common misunderstanding about Bitcoin security, because it's felt like a digital security or a digital bearer asset, and in a way, it's the best or the worst of both aspects. It's bearer as gold, but it's digital as Apple and the US Treasury. And you have to solve these new challenges, and the traditional finance ecosystem is not well suited for that. Not yet, at least.
Yeah, I mean, I think that when you historically think about banks, right? Banks started from basically being those huge vaults that will hold your gold or your cash, right? And then I think over the last, 200 years, probably 100 years, it evolved to be just digital databases that are clearing somewhere. People think that the banks are actually custody your equities. It's actually like in DTCC that there is a database that says to which bank this block is designated, and then in the bank there is a subledger which says to which customers, and in the broker dealer there is another ledger. So it's a fairly complicated system that clearly deviated from where they've been maybe 100 years ago. But I think that fundamentally, with it's not that you don't have any bearer financial assets in the traditional space. It's just that the law and order over there had evolved over the last 100 of years to basically solve this. Now with crypto and Bitcoin specifically, because it is a technology that is compatible with the internet, right? It's basically the technology that brings money to be compatible with the internet. You now actually basically having the problems of, it basically becomes a cybersecurity problem, right? So instead of having a physical security problem, it becomes the same security problem, but in the virtual space. Now, I mean, I come from, I spent 2 decades of my career in cybersecurity, so it's not that I'm going to sit here and say that cybersecurity overall is a problem that is being solved, but it's definitely something that, just generally speaking, as the humankind becomes more and more virtual, and as we basically starting to see more and more of this metaverse stuff, this is a problem that we will all need to deal with, regardless if we talk about Bitcoin, or we're talking about our personal finance, or we're talking about just our social interactions, right? And therefore, I view our mission as a custody technology provider for this space is really, bringing the best of breed, bringing the most innovative cybersecurity technology to, protect those assets.
So one of the things that I work on a lot is proof of reserves, right? This idea that a custodian can prove to the customer that they hold adequate assets to meet the total customer liabilities on their platform or through their service. Do you think that that's an important area to standardize? Do you think it's important to institutional customers? Is it something that you hear about in the marketplace generally? Maybe Henson, you first.
So I think all of us, for me, proof of reserve isn't as strong a concept because we are fully auditable, and any of our clients can look onto the blockchain and see their assets, and we are heavily audited by our regulators and our outside auditors, and we exhibit that what we say we're holding in custody, we have. The proof of reserve concept on something like stablecoins, I think is an important conversation, and I think regulators are trying to get their arms around that while stablecoins are not at the level yet that they represent systemic risk, although USDT is in the 80s of 80-something billion. It's not at the point where it's systemic risk, but to give credibility to the system, if settlements and payments and lending protocols and decentralized exchanges all start to be settled with stable coins and the number becomes an enormous number, I do think proof of reserves for stable coins is probably something that needs to be ironed out over time. I didn't quite answer your question, but that's my thoughts on the space.
It's right. The term proof of reserves too is a bit living right now and evolving. It means different things to different people still, I think. So I think what I heard you say is that for your clients, individual wallet, for those assets, right? So they know their public key, they can look into that address and see the assets that are there, and they know their own holdings as well, so they can tick and tie that. But in a shared custody model where you have, commingled assets, essentially, I think it potentially becomes much more important, right? But yeah, go ahead, Michael. Looks like you had some thoughts.
We started the company, the old company, on the idea that the custody protocol should be open and transparent and verifiable. And the key to the verification is providing proof of reserve. And I can tell you, the first one to be happy about that are our auditor, because they can see the asset we have and they just attest the liabilities we have. And so matching asset and liabilities, you prove to have solvency, and there are a lot of shenanigans that can go behind the scene with auditing. Even with proof of reserve, you could just lend, Bitcoin and prove that you have them. So the way you provide that proof of reserve should be consistent in time, well documented, auditable by anyone, reserving to your internal and external auditors just the part concerning the liabilities. I think that might be or should be the way forward.
Yeah, I think that's not only an important property, but I think this is one of the most important properties, and probably, I think a lot of people are basically always talking about why this system has defects compared to the old system from security and things like that. I think that actually this system has so much advantage, right, from a transparency and auditability compared to what happened, compared to what happens in the old system. For example, inherently, if I have money in the bank, they're running on a partial reserve, right? That's not even a question. Inherently, when we look at what happened with Madoff, someone managed to basically defraud the most sophisticated global investors, for a decade, that he was basically running the books properly, right? I think that the advantage with crypto and with Bitcoin is that it's a bit like around the not your keys, not your wallet, but not your coins, but the fact that the user can be a participant, a direct participant, or they can actually verify cryptographically that the reserve is there, this is one of the biggest advantages that this system has. Now, just like, from our perspective as Fireblocks, clearly the way that we run the technology and provide the service, it's always segregated and always the client has at least part of the key. So there is an inherent proof of reserve over there. But a lot of our clients that are using our solution, they do run either, they either fully on the keys, or they also like sometimes run omnibus accounts, especially when we talk about retail. We power a lot of different exchanges, a lot of the different super apps, and they need to basically verify to their users that there is a proof of reserve. We worked with a lot of the audit firms to basically make sure that there is a way to invoke this kind of signature to prove that the reserve is over there, and for whether the auditors or directly the clients to see that the coins are over there, and it's not just like some kind of fake balance that they see in their app.
All right, with that, unfortunately, we're out of time, gentlemen. Appreciate it. Thanks, everybody.
Thanks so much.